we're going to look at time value and how its impact influences the value of an option. There are two parts to an option price. That's the time value and the exercise value. Those previous exercises that we went through were isolated strictly to the exercise value of the option. The time value is that added amount above and beyond the exercise value, and the time value is what the option seller gets as far as compensation for taking on the risk of delivering something to you in the future, be it cash or the asset.
Mm-hmm.
Now we're going to take a look at Walt Disney, the
Mm-hmm.
shares of Walt Disney, and a couple of different options.
Okay.
And here is Walt Disney stock. It's at 113
Mm-hmm.
right there, and we're going to take a look at the April options. They are in this column right here. And we're going to take a look at the 115 call. Now, I have the July 115 call. That was not published in the newspaper. That was off of a quote system that I got.
Okay.
But you can see here's the July 115, well, at least we have the April 115 call. You just go down the April column and look at the call. There's our call 115, and they match up right there.
Mm-hmm.
So the April 115 call is at 3 5/8.
And that was close to at the money because the stock was at 113.
Exactly.
Mm-hmm.
Exactly. Now here's a chart of Walt Disney at the time, and we're at 113, and
Oh, it had quite a run-up.
it had, boy, it sure had. It's been a pretty good company.
Mm-hmm.
You know,
Mm-hmm.
the shareholders and the employees have been pretty well,
Mm-hmm.
and even the customers have been pretty well rewarded with the company.
Right.
But what we're going to take a look at, what we're more interested in, is how the options behave. And at the time, the April 115 call, it had 60 days of life to it at the time.
Okay.
And you can see that as you get closer and closer, here's our number of days till expiration.
Okay.
As we get closer and closer to expiration,
Going from
the
60 down to 0.
the steepness of the curve starts to get more severe.
Mm.
And as you get a higher and higher priced asset, that parabolic shape gets more and more severe.
Mm-hmm.
And I'll give you an example. Look at this last 10 days. You're going from 1 all the way down to 0, so you have a 1-point decline. Well, this 10-day period, you're going from about 3 5/8 to 3 1/4, so you're losing 3/8.
Mm.
So you're losing 3/8 during this 10-day period right here.
Which is between 60 and 50 days.
Right, and then at this point you're actually losing quite a bit,
Between
quite
10,
a bit of ground.
10 and 0, yes.
Now this gets to the heart of the matter of why would you choose an option? Let's say your time horizon for being bullish on Disney was, I think Disney shares are going to do something good in the next 2 months.
Mm-hmm.
Well, that almost tells you that this curve really starts to get steep right here in that last 30 days. If you then go out and buy a 2-month option, you're looking at expiration during the time frame that you have your time horizon.
Right, so the time is working against you.
It's really working against you. If you think Disney is going to go up pretty good sometime in the next 2 months, you literally want something that you're actually out of the position when 2 months come.
Right.
So what I like to do, because I know the way this thing performs in that last 30-day period, I'm going to want 2 months is my time horizon,
Mm-hmm.
and I want to be out a month ahead of time because
Okay.
I don't want to be right here.
Mm-hmm.
I would say that we're going to take this little area right here, and this is our little death area right here.
Stay out of there.
Yes, we'll just draw a big X right there.
Okay.
You want to be out by then.
Uh-huh.
So you want to, if you have a 2-month time horizon, just add another month onto it. So you want to buy a 3-month option.
Mm-hmm.
Well, the next 3-month option that was available on Disney was the next option series that was available at 3 months or more was the July series.
I see. Okay.
And you can see that, and again, we're taking the risk into consideration.
Mm-hmm.
I'm always worried about what happens if things go wrong. If Disney stood still for 2 months, in this instance, I'm losing 100% of my investment. In this instance, we're spending a little bit more money, but 90 or 60 days from now, we've only got that little bit of a decline, not even a 2-point decline.
Mm-hmm.
So you're not into this area right here that is, we're not yet into this area. This is what we want to be out by the last 30 days.
Mm-hmm.
So in this instance, we could be in it for 60 days and be out well within that time frame.
Mm-hmm.
So that's part of the series selection, the expiration month selection.
Okay. So this
now,
is how you decide on the contract that you're going to
now,
use.
if you're selling an option,
right, it seems like the opposite would be true.
Right,
you want to capture that.
Right, you want to. So, like on our credit spreads,
mm-hmm.
you want to be in it for a shorter duration,
mm-hmm.
and not only for that is if you think news is a catalyst for market movement.
Right.
The more time you give it, the more likely you are to have a catalyst to come on and drive the price big, volatile up or down.
Mm-hmm.
So it actually works against you in 2 ways. When you sell an option, you don't want to give it much time. So this is right here, you want to be the seller right in that period,
right.
and you want to be a buyer out in here. So here we want to buy.
Mm-hmm.
I'm going to try and write with this thing for the first time. We want to buy right there.
Okay.
And here we want to be the seller.
Mm-hmm.
So that's how duration impacts the selection, the strategy selection that we've got. And here we are at Walt Disney. If you bought those April options,
mm-hmm.
Here's where you would have been. Here's where you would have been on the expiration.
Okay.
And what we had the 115 call.
Yes.
So those options would have expired worthless.
Yeah.
And we talked about how you give it longer time. There's a catalyst that can come along and drive things.
Sure.
So here we would have been, if we bought the April option, we would have lost all our money. If we bought the July options,
right.
we would have still been losing money, but we would have gone from 6 1/4 to about 4 1/2. So we still would have had our position, but we would have been down.
Mm-hmm.
But the next chart, here's a previous chart we looked at. Look what happened the week after the April options expired. Now you really would have been kicking yourself, because here we would have expired right there. The next week, Disney came along with some news that drove the stock price up dramatically, and that July option that was at 6 eventually went up to 15 1/4. So
more than double your money.
And the April option guys, who were right about the direction,
right.
they were just wrong about when the news would come out.
Right. And
they lost all their money.
And the time decay ate
right.
away at their investment.
Right. So if you're going to buy an option, buy it with 30 days more of life left than the time horizon you have for the news.
Okay.
So in this instance, if you had a 2-month time horizon, anything longer than 90 days would have been okay.
Mm-hmm. All right. That's an important piece of information.
It really is. I mean, think how frustrating it would be to be right about the news. You know, the event's going to come, but you get the timing off by a week.
Mm-hmm. The guy's going to think, I got out, so then they were able to take the price higher without me.
Exactly. And that's why the options trading is notoriously, options traders are notorious for losing, because they don't take some of these other factors into consideration. The other thing that's real important is strike price selection. The deeper the option is in the money, the higher the cost.
Right.
So you're raising your risk. You're also lowering your leverage. So the greater the risk, there's also a greater probability for profit.
Sure.
So you're increasing the risk and you're increasing your probability. And on a percentage basis, you're actually lowering your profit potential.
Mm-hmm.
So things are offsetting themselves. In the further the option is out of the money,
Right.
you're lowering your cost, you're getting more leverage, but with that lower cost comes lower risk, but also a dramatically lower probability of profit.
Right.
So it just depends on what your risk tolerance is.
Right.
Just realize that when you reduce your out-of-pocket expenses, generally speaking, you're also going to lower your probability for profit.
Right.
So if your probability is more important to you, don't lower your out-of-pocket expenses.
Mm-hmm.
This is a chart of Eastman Kodak, and in this instance, Kodak we've had a nice little, it's been in a downtrend, and it's been dropping, a series of lower lows, but then it starts making the turn, and we've got a series of higher highs.
Mm-hmm.
So we've actually got a nice little uptrend. Let's say you want to be bullish on Kodak.
Mm-hmm.
And you also know that they are going to come out with earnings news, and they're going to do it sometime in April.
Okay.
So you say, all right, I think the news is going to be okay. Well, so you want to buy an April or a July option or whatever. You're going to buy an option. We're going to focus strictly on strike price here.
Okay.
So here we have the Eastman Kodak options, and we're going to look at the difference between the April 65 call versus the April 70 call.
Okay.
Here's our April column, and there's our calls and 65. So we're going to look at the difference between these two options right here.
Okay.
Now, if we were to buy the April 65 call, our break even is the 65 plus the 4 is 69. And at 70, we're going to actually be making money.
Yes.
And I want to review this real quickly. 70, we buy the 65 call, we had the right to buy the stock at 65. We buy it at 65, sell it for 70.
Yes.
And in the open market, we net 5, we paid 4 for the option, we make $1.
Yes.
And the 70 call, at 70 we're actually losing money, and we don't start making money until 70 plus the price of the option, which is 1 7/16, so 71 7/16. So we need Kodak to go up. So we're increasing the hurdle. We've gone from 69, now we need to go up to 71 and change. So if Kodak goes up, we may make money, one we may not. And unfortunately for the price, for the out-of-the-money option buyer, they did not make money because, now, and think about what's going on here. Here you're buying your options and you're expecting good news. You're expecting good news from Kodak before the options expire.
Mm-hmm.
You get it. I mean, you're right. You are right. There's the good news. It goes up big. But you got the big wrong. How big is big? If you bought the 70 call, you lost money because it went up but not enough.
Not enough.
If you bought the 65 call, you made money.
Right.
Because our break even was 69 and it went up to 70 5/8. And that's why the out of the money options, you really have to have the stomach for consistent losing.
To cash in on that one big time when it's really going to reward you.
Yeah, those are the lottery tickets because, I mean, imagine I'm going to be bullish on Kodak. You get the direction right. And there's going to be good news. You get that right. It's going to happen before April option expiration. You get that right. You get 3 things right and you lose money.
That would be discouraging.
That would be discouraging, and that's why that's why it's so important to choose the strike price correctly and give yourself a reasonable chance. I mean, I can't imagine anything more demoralizing than getting 3 things right and then and I still lost money.
So you like to be as close to at the money as you can when you're buying that strike price.
At the money or even in the money.
Even in the money.
Yeah.
Okay.
Yeah, I prefer one of the two. I do not like to buy. Well, guess what I like to do? I like to sell out of the money options.
Well, sure, because it looks like that more often than not is a profit for the seller.
Any option selling is more profitable. Is profitable more often than not.
Mm-hmm.
It's just this is one of those things where what if Kodak went up to 90?
Yeah.
I mean, then the
Yeah.
option, then the 70 call seller is really in big trouble.
That's right.
But it didn't, and it doesn't happen very often. And the call buyer, more often than not, is going to get demoralized and stop trading well before something like that really spectacular comes along.
Right.